Hey guys, welcome to the Bitcoin Fortress podcast. This is episode 193. Today is December 7th, 2025. We are at block height 926,865. Moscow time, 1,094 sats per dollar, and on-chain fees are a comfy 1, 1, and 1. As always, this podcast is for educational and entertainment purposes only, not financial advice. Do your own research. Don't trust, verify. In today's episode, we'll unpack another wild week for Bitcoin price ETFs and macro. We will hit regulation and enforcement news, cover state adoption, especially Texas going full cowboy on Bitcoin. Talk through Wall Street's evolving Bitcoin game, recap podcast themes from the Bitcoin universe, and we'll wrap up with a featured Substack post, practical ways to become more resilient. So with that, let's jump right into it. We'll start with price ETFs and market structure. CryptoSlate ran the headline that 2025 has officially been a wipeout year for US spot Bitcoin ETFs, with assets back to early 2024 levels and about 48 billion in AUM erased since October, even though hodlers are still stacking and IBIT remains huge. ETF flows are now the dominant marginal buyer seller, and we've talked about this quite a bit at the in the podcast. When they buy, price go up, but they are also very quick to sell and take their profits. Wiping out a year of inflows in 6 to 8 weeks shows how violently Wall Street can move. The old saying, the market takes the escalator up and the elevator down. Yet structurally, the products still exist, infrastructure is mature, and this looks like a massive reset, but not the end. ETF DB, using Farside Investors data, reported that US spot ETFs saw 3.4 billion in outflows recently, but year-to-date flows are still plus 22.3 billion, with IBIT alone up 25.3 billion for the year. Translation: more than a year's worth of inflows is and still net positive, but a big chunk left in a short window. And this tends to support the idea that this is deleveraging, not abandonment. Several pieces, Contribune, because Bitcoin, etc., focused on December 4th, when spot ETFs recorded about 194.6 million in net outflows, IBIT alone at 113 million, FBTC about 54 million. Analysts blame the unwind of leverage basis trades and macro jitters around the Bank of Japan. Good chance here. A lot of tourist hedge fund leverage is exiting. And of course, very painful short term, but ultimately healthy for price discovery. CryptoRank highlighted that December 5th flipped back to net positive ETF flows of about 54.8 million, but interestingly, IBIT still had outflows. So flows rotated into other funds. This shows competition between issuers and also shows that this isn't one monolithic IBIT trade. Investors are actively shifting between products. Another CryptoSlate Glassnode analysis argued that Bitcoin price action is now dominated by off-exchange flows, especially ETF demand and OTC desks, with on-chain activity relatively muted compared to past cycles. We're watching a new market structure, fewer retail casino vibes on exchanges, more slow institutional allocation. And for traders, ETF flow dashboards are now as important as exchange order books. A separate CryptoSlate macro piece framed the current drawdown as Bitcoin's bull market, a slowdown, not a breakdown, analyzing funding rates, ETF flows, and long-term holder behavior. Big buyers have stepped off the gas, but they haven't fully reversed. Fits the thesis of a mid-cycle shakeout, not a cycle top blow-off. Of course, in my own mind, I'm mentally preparing myself for the bull market, or at least sideways chop, for a long time. And that means you just continue to stay humble, stack sats, make sure you've got some cash on the side, and, Bitcoin does what Bitcoin's going to do. But there are people still saying that we're still in the bull market. This is just a typical 30% drawdown, which freaks out the normies. A rather long FastBull analysis laid out a key price levels for December, support around 80.4 thousand, deeper retest risk towards 66.8 thousand, and major upside confirmation only if we reclaim the 93.9 thousand to 97.1 thousand zone and eventually the 112,000 region. Now, if Bitcoin really touches all those price points, if you're dollar cost averaging, you're just picking up cheap sats at the bottom and a little bit more expensive higher up. And that's why DCA is the winning strategy, because you could also sit around and wait, and 66.8K doesn't show up. And then what? Then you still got cash and Bitcoin's over 100. So again, DCA is the way. Again, this is a very heavy technical analysis piece, but the narrative is downside risk remain, confirmation for next leg up, needed strong ETF inflows and liquidity. The same FastBull piece also flagged 1.8 billion plus of December token unlocks across various shitcoins, warning that the new supply could pressure the broader crypto market even if Bitcoin stabilizes. So this is a good contrast, folks. Bitcoin has a known issuance schedule. Altcoins keep dumping new supply. So something else to watch out there as part of the narrative of why does Bitcoin keep trading sideways? What happened to the bull market? Bitcoin will do what Bitcoin will do. Business Insider summarized the month end as Bitcoin stumbling into December, about 32% off the October high above 120K, and trading in the high 80s amid ETF outflows, Bank of Japan worries, and concerns that big corporate treasuries like Strategy could eventually sell. This is a nice reminder that a 30% drop feels brutal to normies, but is standard issue volatility for Bitcoiners. So strap on your shield, prepare for battle. Next up, institutions, Wall Street, and products. First piece, Reuters reported that MSCI may kick, quote, cryptocurrency holding companies out of its indices, including Strategy, with potential outflows up to 8.8 billion if other index providers follow. Michael Saylor says basically we'll be fine, and notes Strategy is built to be a leveraged Bitcoin proxy. If MSCI does this, it could force some passive funds to deallocate from Bitcoin heavy corporates, and yet it may also push more people into spot ETFs or native Bitcoin instead of equity wrappers if they're looking for that exposure, which is kind of interesting if you think about it. Another Reuters piece covered how 2x long strategy ETFs are down 85%. Whoa. And even the short product is down 48%. What? After wild whipsaws, strategy itself is down over 40% this year, and it slashed earnings guidance from a potential 24 billion profit to a possible 5.5 billion dollar loss. Of course, that's because they mark up and mark down their Bitcoin stack to market, so that's what's sure driving that. Assuming Bitcoin ends the year far below earlier optimistic scenarios. So this, my friends, is a great teaching moment. Leverage stacks on leverage. Bitcoin, leverage balance sheet, leverage ETF. This is why you don't need leverage if you just hold Bitcoin for the long term. But some people like to trade and some people like the casino. So they pile into leverage long and leverage short strategy ETFs and they get appropriately wrecked. Stay humble and stack sats. Reuters also reported that Bank of America will allow its wealth management advisors to recommend crypto exchange traded products starting January 5th, 2026, not just execute trades. They even suggest 1 to 4% allocations for suitable clients. Wonder what suitable means. This is a big institutional signal, though, advising, not just passively allowing, and also shows how much Trump era regulatory easing is emboldening big banks to move. But of course, the real reason why the banksters want in on this is because of one thing: money. They want to make money. They don't care about Bitcoin. And let's not celebrate too loudly about the banksters getting more involved in Bitcoin. It is meant to be held individually in self custody. That's the way it was built. Barron's wrote that Vanguard has reversed its no crypto policy, letting clients buy third party crypto ETFs and mutual funds on its brokerage platform. They still have no plans for an in house Bitcoin fund, similar to their stance on gold. Now, that's huge culturally because Vanguard was one of the last big, call them boomer brokerages holding the line. But now your average 401k refugee, assuming the company allows that option, can at least route some brokerage savings into a Bitcoin ETF if they really want to. I guess if you have a self-directed IRA with Vanguard, then you should have those options available to you now. So, but again, not your keys, not your coins. Investors.com had a piece revisiting strategy as a macro Bitcoin bet, explaining how MicroStrategy's share price effectively behaves like a leveraged spot ETF plus corporate premium discount. This is a nice tie-in to some previous episodes. We've talked about MicroStrategy versus just holding sats. Again, if you like trading, if you like volatility, if then sure, buy MicroStrategy, buy some of these Bitcoin treasury companies. But if you just really want to save in Bitcoin, just stay humble, stack sats. A niche but interesting article described BHODL, a company that holds 155 Bitcoin in a self-custodial treasury and uses Lightning channels to earn around 6% native Bitcoin yield by routing payments without rehypothecation or CeFi risk. This is a great example that Lightning yield is real, but limited and requires actual routing work and risk management. And we would, of course, contrast this type of yield with the altcoin DeFi casinos. This is a little bit more like earning interest on a treasury security, Bitcoin being the treasury security. Next up, we will cover regulation, policy, and crackdowns and see what's going on. There's actually been quite a bit going on in this area recently. The CFTC announced the first listed spot crypto products on US regulated futures exchanges, calling this the start of a new, quote, golden age of innovation, unquote, in commodities style crypto markets. This is big. Fully regulated spot venues with CFTC oversight is exactly what many big institutions wanted. This also tightens the link between ETF pricing, futures, and spot. So it gets some of the arbitrage out of the market, making the market more efficient for Bitcoin derivatives. CryptoSlate followed up with a piece arguing that recent CFTC leverage and margin rules effectively opened the door for pensions, insurers, and mega funds, an estimated $25 trillion in assets to participate in regulated crypto markets once their internal risk boxes are checked. So the plumbing for the next wave of institutional adoption is being built now in the bear chop. So don't sleep on that. Reuters covered a joint operation where Swiss and German authorities shut down CryptoMixer.io, seizing servers, user data, and about 25 million euros in Bitcoin, alleging Bitcoin billions in laundering volume. So this is a classic privacy versus surveillance story. Mixers are framed as crime tools, but also used by people fleeing authoritarian regimes. Uh, Again, a reminder about self-custody, coin control, and privacy best practices. Uh, you want to be smarter than the people that are trying to figure out how much Bitcoin you have. And that includes criminals as well as, well, we'll just leave it there, criminals. A Canadian report detailed how the Canada Revenue Agency has aggressively targeted crypto traders, recouping more than $100 million through audits and settlements and forcing data disclosure from platforms like Dapper Labs. But so far, no criminal charges. Well, you go, Canada. Look at you. So this is the KYC honeypot thesis in action. Once your data is there, the tax agencies will use it. And of course, if you don't like that, learn to acquire and hold Bitcoin in more private ways legally. Decrypt reported that China is ramping up enforcement again, targeting offshore exchanges, content promoting crypto trading, and reiterating that all virtual currency business is an illegal financial activity. Capital controls. Can't let the money leave the country. At the same time, hash rate data, though, suggests there's still unofficial mining activity in China. The ban is porous, but the legal risk is real. TRM Labs released a global crypto policy review and outlook for 2025 and 2026, covering 30 jurisdictions representing over 70% of global crypto exposure. Over 70% of them advanced stablecoin regulation in 2025, and about 80% saw major financial institutions announce new digital asset initiatives. Big picture, regulators are moving from ban and panic to define and supervise, which ironically paves the way for more institutional Bitcoin adoption, although it is very, very slow. Taking a look at state adoption and geopolitics, the big news here, Stateline reported that Texas is now officially the first U.S. state to buy Bitcoin, thanks to a new law allowing the state bullion depository to hold Bitcoin. The first allocation is in the low millions, with more authorized, and other states are already watching closely. This is a major narrative shift, folks. The U.S. state treasuries as Bitcoin hodlers, and a great contrast with paper hands countries like Germany that have been dumping seized coins into the market. Uh, don't be paper hands. Hold, hold, hold. Several follow-up pieces, including from Bitget, BN Crypto, framed Texas as a test case for U.S. state level Bitcoin reserves and speculated that other energy rich or politically aligned states could follow. We could tie this into our long term thesis of Bitcoin as a strategic reserve asset at every level of society, from individuals to companies to states to nations. Game theory touches everyone. An op ed syndicated from Coindesk noted that Trump's new national security strategy talks a lot about AI, biotech, and quantum computing, but never mentions Bitcoin or blockchain, despite his campaign's strong Bitcoin rhetoric. Interesting tension politically pro Bitcoin, but the formal strategy doesn't treat it as a strategic technology, at least not yet. And I guess you can speculate about whether that's oversight, deliberate ambiguity, or a sign that Bitcoin is still seen primarily as, quote, just an asset as opposed to something of national security priority. I could also probably argue that it's a good thing because when something becomes a matter of national security, um, the government might want to try to take it away from you. And good luck with that, by the way. Uh, you know, not going to happen. Not here. But it's interesting because, obviously people have written about Bitcoin being like some kind of a national strategic asset, perhaps the future of warfare. And that just hasn't registered yet. So again, I don't know how to feel about that. I think maybe it's probably a good thing for right now. The FastBull article that we mentioned previously also highlighted a thin margin. Now they're moving on to mining infrastructure and Lightning. A thin margin environment for miners. Difficulty near 150 terahash. Hash price around 38.3 dollars per petahash per second per day versus an estimated $40 break even for many operators. Uh-oh. Some miners are deciding whether to power down or keep bleeding, yet the hash rate stays strong, reinforcing the idea that the network survives even when margins suck. That same piece cited reports of a U.S. Department of Homeland Security probe into Bitmain over concerns that ASICs could be remotely accessed, noting Bitmain may control 80% of the ASIC market. If true, any sanctions export controls would reshape the mining hardware landscape, and another reason why open source designs and diversified manufacturing matter for Bitcoin's resilience. And finally, for this segment, Fastbull noted that China's estimated share of global hash rate has crept from about 13.75% to about 14%, even after the 2021 mining ban, though experts still think a full legal reversal is unlikely. Again, a great reminder that hash power follows cheap energy and regulatory arbitrage, not press releases. Well, let's take a look at narratives, FUD, and culture next. The Guardian reported that American Bitcoin Corp, tied to Eric Trump, saw its stock plunge nearly 39% in half an hour and is now down about 78% from its September peak, tracking Bitcoin's volatility and the leveraged ETF carnage. This is what happens when you bolt politics and leverage and mining onto Bitcoin. For Bitcoiners, it's a reminder Bitcoin is robust. Bitcoin themed equities are not Bitcoin. Moving on into the FUD, and this is a big one. Business Insider covered Michael Burry calling Bitcoin the quote tulip bulb of our time, saying Bitcoin at $100,000 was quote ridiculous and that it's quote not worth anything unquote, tying it to criminal activity and speculation. So this is great. He acknowledges the reasons for Bitcoin's existence, and then he still dismisses it. This also illustrates how even very smart legacy investors struggle with non-sovereign, non-cash flow assets. Maybe, well, there's people that'll just like Peter Schiff that'll just never get it, and so you just give up on them and you move on. A long essay from the Bahnsen Group reiterated a classic wealth manager stance. Bitcoin is, quote, not a productive asset, unquote, purely speculative and unnecessary for diversified portfolios. This is the exact mindset many listeners will hear from their advisor. So, and you probably have if you have an advisor. I don't. I don't trust anybody. I especially don't trust the government, but I really don't trust financial advisors. But this is a great opportunity to contrast fiat nominal diversification with actual protection from monetary debasement, which, of course, Bitcoin gives you. And as a savings tool, it's certainly nice to just save and not have to worry about the next trade and have to watch CNBC and try to figure out, um, you know, where, what to invest in. Honestly, that's just now, in hindsight, to me, it's been the greatest waste of time in my life when I used to do that. Now I find peace. And finally, in this segment, other coverage around TRM's 2025 crime data shows illicit volumes down versus 2024, but still substantial, with particular emphasis on AI-driven scams and pig butchering using crypto rails. Good reminder that most crypto crime is still fiat on and off ramp fraud and social engineering, not Bitcoin protocol failure. And again, we should reinforce the basic OPSEC. Don't click random links, verify contacts, and use hardware wallets. And of course, don't share your seed phrase ever. And if it's the IRS calling from India and they want you to pay your outstanding taxes with Walmart gift cards, that's probably a scam. Moving on, the Bitcoin podcast themes of the week. Let's zoom out and see what the podcast universe has been talking about. So we have What Bitcoin Did, Money, Maps of Reality in the Fourth Turning, Bitcoin AI in the Fourth Turning with George Bodine, published on December 3rd. Peter McCormick dives into fourth turning theory, AI, quantum, and why the next 3 to 5 years may be the most volatile period in Bitcoin's history. The next episode, How Broken Money Distorts Reality with Seb Bunny, who's great Australian Bitcoiner. Love that guy. December 6th. That explores how fiat money warps people's maps of reality, careers, housing, family, politics, and argues Bitcoin is the only force capable of realigning incentives. So, theme number one, broken money equals broken civilization. Bitcoin is a tool to rebuild accurate mental models of reality. Next, TFTC monetary base and long-term perspective. TFTC 689 Q3 2025 monetary base update with Matthew Mazinkas. Smart guy, very interesting guest, and Marty's had him on several times. Marty and Matthew talk about Bitcoin's power curve growth model, the global monetary base, and why current volatility should not panic long-term holders. Theme two, zooming out, if you view Bitcoin against the global base money curve, the recent drawdown looks like noise. Then on Rabbit Hole Recap, there was coverage on the ETF carnage, Texas, and Trump era policy. Latest Rabbit Hole Recap episode digs into ETF outflows, Texas buying Bitcoin, the CryptoMixer.io takedown, and Trump's regulatory tilt. This week is peak Bitcoin meets state power, state level adoption on one hand, mixers and exchanges under the gun on the other. And the fourth one under Lightning and payments, Cash App and Treasury Lightning yield. There have been ongoing discussions across pods and blogs around Cash App's Lightning rollout, US dollars to Lightning Network BTC payments, and the Lightning yield narrative for corporate treasuries like BHODL. And so the fourth theme being Lightning as real infrastructure, not just a toy, but a way for businesses to earn yield and for consumers to pay in sats or even US dollars over the Lightning Network instantly and for very low cost. So, if you listen across what Bitcoin did, TFTC, Rabbit Hole Recap, the big themes are broken money and distorted reality, zooming out to the global monetary base, state adoption versus state crackdowns, and Lightning maturing into serious payment rails and yield infrastructure. Next up, I wanted to talk about this week's featured Substack post. And again, links in the show notes to all the articles that we cover, including the podcast, the Substack post, as always, every week. So this week's featured Substack post is practical ways to become more resilient. In the piece, I talk about resilience, not as some abstract virtue, but as a set of practical habits. First, fix the base layer of your life, your money, by saving in Bitcoin instead of chasing yield in a fragile fiat system. Second, lower your time preference. Focus on health, skills, family, and community rather than short term price action. Third, build redundancy, financial redundancy, emergency sats, multiple income streams, digital redundancy, backups, hardware wallets, multi-sig, and social redundancy, strong local relationships and trusted Bitcoin circles. I also emphasize the mental side of resilience. Bitcoin volatility becomes manageable once you frame it as a multi-decade monetization process rather than a week-to-week trade. The post ties all this back to the idea that holding Bitcoin is a powerful first step, but real resilience also means building a life where you're less dependent on fragile institutions and more grounded in things you control. And again, a link to that article will be in the show notes, and you can read the whole piece. Before we wrap up, a quick reminder about my three Bitcoin Fortress books. Bitcoin Fortress Simple Guide for Beginners is a no-nonsense introduction to what Bitcoin is, why it matters, and how to get started safely. Bitcoin Retirement and Estate Planning, how to integrate Bitcoin into your long-term retirement strategy, tax planning, and inheritance with a focus on self-custody and multi-sig. And finally, the Bitcoin lifestyle, shifting from fiat anxiety to a low time preference life, where Bitcoin is the monetary foundation, not the obsession. If you're enjoying the podcast, these books go a lot deeper and are great to hand to friends and family that you are trying to orange pill gently and just in time for the holidays. That's it for episode 193 of the Bitcoin Fortress podcast. This week, we watched ETF flows whip around, Texas become the first U.S. state to stack sats, regulators simultaneously open doors for institutions and slam doors on privacy tools, and the usual cast of legacy finance characters tell us why Bitcoin is doomed. Tulips, while they quietly build access rails for it. Through all of that, the plan remains simple. Stay humble, stack sats, secure your keys, and focus on building a resilient life around the people and things that actually matter. If you like this episode, please subscribe, leave a review, share it with a friend who's trying to make sense of the madness. Thanks for listening, and I'll catch you on the next one. See you next week. Bye bye.